Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. It's Wednesday, June 5th. It's 1 o'clock on the East Coast. How are you?
I'm good. How
Elizabeth
are you?
just had, what did you just have?
Oh my God. Thai green curry. Don't eat spicy food before going on camera. My face is sweating. My nose is running. But it's delicious.
Thai green curry.
I just didn't time it well.
Well, no, because when I walked in, you were gavoning. I'm like, what are you eating? You're like, I'm having
Spicy Thai food.
I'm like, good for you.
Yeah.
That's aggressive. Listen, that's you.
Aggressive.
I admire that. I admire many things about you. So today's Wednesday. It's the two of us. Dan went to visit his mom. It was her birthday yesterday.
Oh, I didn't know
Mrs.
that.
Nathan.
Yes.
81, I believe.
Oh, 81
and
years
so he
young.
went to see her. So he's taking the day off. And
Okay.
good for him. He deserved it. So it's just me and you.
Happy birthday,
Carter
Mom.
was yesterday. But today, typically, if it's Thursday, it's what?
It's Wednesday, though.
No. But typically, if it's Thursday,
if it were Thursday, but it's not, it would be Butters.
Bitch. Yes. Thank you.
Okay.
I was waiting for you to say that because
Yeah.
I just like sort of adding that on. But we're going to do John Butters today because you are extraordinarily well equipped to sort of break down some of the things that he's looking at.
Great.
Is that okay?
Fine with me. I love butter.
Anyway, let's watch this. Now, Jacobs, wow, they're on top of things today. I mean, that is today's rundown. Stocks rally, yields fall. And we're going to talk about that. Yes, that's true. But for a brief period of time today, after this ISM services number came out, you actually had a really significant pullback in the TLT. Yields went up, and then obviously it was reversed. Fed's next move, I don't know. Maybe you do because you talk about these things.
We'll find out soon.
Stock market concentration. You and Mario have done some work on that. Is that true?
Well, we did some work by going on the Twitter machine and finding somebody else's work.
That's work. But that is work.
Talk about that.
And as I mentioned earlier, FactSet's earning insight. John Butters, the senior earnings analyst at FactSet. Sometimes hard to say. Dan sometimes throws earnings insight analyst, but that's not what he is. He's the earnings analyst.
Well, I think that probably is what he is, but
he does the FactSets. He does the earning insight, but he's not the earnings insight analyst.
He's an earnings analyst who provides insight.
U.S. Service providers chalk up strongest growth in 9 months. And that's true. I mean, I guess that's a good thing. Now, good news apparently is good news. I thought when I saw this, as I just talked about, I thought, potentially inflationary, potentially yields go higher. And I don't know, Jacob and or Amanda, if we could pull up sort of an intraday TLT chart, and we'll come back to this. But as I mentioned, at 10 a.m., you saw a big drop in the TLT, which obviously mean rates went up. That all was reversed. So there's that big drop that I mentioned, and that was precipitous. And then it got the entire thing back, and now we're sort of going sideways. So let's start there, EY.
So when you look at what happened just in the 10-year treasury too, right at 10 o'clock, we went up about 6 basis points or so maybe even more, 428 up to 435. And then, as you said, it has come back down. So the services component of the economy had been for a little while what we were talking about as what kept everything so sticky.
Yeah.
So we were watching inflation come down, but it was mostly goods, which we knew was happening because we got some of that supply chain issue out of the way. And commodities came down quite a bit too. So that took some of the pressure off consumers. Gas prices fell, blah, 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 blah. But services got stuck. And then people started to explain it away by saying, well, most of it's shelter. Shelter, for whatever reason, counts as a service, so it's not really bad. But then you get a survey like this that tells you that services are still in demand and are still being paid for, which would tell me that it's probably going to feed through to inflation, or at least keep that component of inflation sticky. Now, to your point, good news is good news. Maybe a rise in yields was technically good news to the market for a little while, thinking that long-term yields are going to stay high as a reaction to strong economic data. I would agree with that. I think that's probably what people did at first. But now giving it all back is this expectation, or maybe even just a desire, no matter what, to get the Fed to somehow cut rates.
Fair enough. Listen, I think that is a cogent argument. We'll see how it plays out. I think where I stand in terms of inflation, in terms of yields, and I was looking really smart 2 weeks ago. I'm looking really dumb now. And you look at this 10-year yield chart, the volatility is clearly back. I mean, we were 465 5-6 trading sessions ago. Obviously, where we are now, basically, approaching 426, 427 or so. Down through the moving average. If we put up our chart, our static chart, you'll see that to be the case. And yields appear to want to go lower, but every time that's happened over the last, since the start of the year, every time you think, okay, here's the moving yields to the downside, it stops precipitously and then it starts to ratchet back higher. And maybe that'll be in the form of the jobs number later this week. I have no idea. Or maybe that's going to be in the form of some treasury auctions that are out there in the ether that haven't been particularly good over the last few that we've seen. I don't know. But right now, lower yields are sort of giving some hope, I guess, some optimism to the broader market. And that's manifesting itself in an S&P 500, which, by the way, as we're sitting here, is effectively at all-time highs. I think the all-time high in the S&P was 53.41 and change. Here we are at 53.37.
Well, again, I talk about relationship problems a lot. This is one of those.
In markets.
Yes. Yeah. I mean, not publicly. I don't talk about relationship
No, but
problems.
all
relationship.
No,
that's a different show.
Well, that's a different show. But I will just say this: even the healthiest relationships
absolutely
have their problems.
Of course,
isn't that fair?
Yeah.
So it stands to reason that relationships in the financial sector and markets are going to be laden with problems.
Yes. Yeah, I mean, it's a
some
natural
reconciled,
thing.
Some not reconciled.
It's a natural thing, whether you're bringing together two humans,
yes,
or two variables,
yes,
two sets of data. They don't come from the same background.
They clash.
They don't come from the same belief system, and they're bound to clash. So one of the relationships that is one of the broadest relationships we talk about in the market is just the correlation between stocks and bonds. So what we're seeing today is a positive correlation. We've got a rally in bonds and a rally in stocks. That's not usually how it's supposed to work. Usually it's in the reverse. So this is sort of a peculiar moment, but we've had many of these over time. I think what is starting to happen, or maybe what's been happening for a little while now, is that as yields fall, if they're falling for the right reasons, or at least if people are perceiving them to be falling for the right reasons, then we can let stocks continue. If they're falling for the wrong reasons, then we can't. Now, what would those right and wrong reasons be? You mentioned the payroll number that's coming on Friday. I'm willing to bet, and I've said this for a while, if we get, which we're not expected to get this, but we're going to get an unemployment rate, the survey says 3.9%. I think once it crosses 4, that will stop being good news.
I agree with that.
I think that is a mental threshold, even though 4 is not a concerning number. If we get an unemployment rate of 4 or 4.1, whatever, I don't think that's a concerning number, but it's a mental threshold. And I happen to know this because I've been writing my outlook, which you will talk about and feature next week.
In absentia.
No, I'll be here.
Really?
Yeah.
You are badass.
Yeah. That we are in now, I believe, the 28th consecutive month of unemployment below 4%. That is a long, long time and a record, if I'm not mistaken. So we're at this place where we've gotten used to a lot of these variables acting a certain way, staying at a certain level. And I think that the market has this sort of unbridled anxiety about if anything changes over certain thresholds. But in the meantime, let's just be enthusiastic about it all because there's no reason not to be.
Well, that's clearly what the market is saying right now. And enthusiasm and a myriad of different, and the fact that I think people are looking past so many of the concerns that I know you share with me that I don't think have gone away. Yet I think people have said, you know what, for whatever reason, it's different this time, or we will sort of navigate our way through. GDP is interesting, and you've done some work. This actually was your work, and they're obviously within GDP, they're components in GDP, right? And I think to a certain extent, they become pretty interesting. So you see how these things break down.
Yep.
What are you suggesting in this model? I mean, the last GDP print we saw was disappointing in a word. I think it made sense. Some of the numbers we've gotten since suggest maybe that trajectory will start heading back up. I have no idea. Talk to me about this.
So I'm going to take you back to the beginning of this chart. Look at that negative number. That's the second quarter of 2022. That was what people would have called the technical recession that we had, although it was very brief and shallow. I don't count it as a recession because I don't think it reset the business cycle. But if we start there, that was that negative GDP growth in the beginning of 2022. And then we went through a myriad of quarters where we were at 2, 2.5, 3, 4.9.
Mhm.
Those were great growth numbers. And that's a lot of what the bull case rested on, that growth was still strong despite all of these rate hikes, all of these attempts to slow down the economy. It wasn't working. And the argument on the other side was it just wasn't working yet. So then we look at this Q1 2024 GDP number, which actually original data came in at 1.6%. It
And
was
they
revised
revised.
down to 1.3%, which was a pretty big surprise. So we've got our first quarter now of what I would call below trend GDP growth. Now look at this. The model that we're showing here is the Atlanta Fed GDP now. That's the shaded bars to the right. And this is just the progression of what Q2 estimates are. So at the end of April, they were 3.9, and then they've come down steadily since, with the latest read being 1.8%. So we've gone from almost 4% again down to below trend growth. Now, that's not a problem. And in fact, the Fed has said many times we need a period of below trend growth in order to take care of this inflation issue. So I think some of this might actually be welcomed. The rub is, and if you go through my Twitter profile, you have to scroll back pretty far, but if you go through it to that revision down to 1.3% for Q1, you'll find that most of that revision was due to a reduction in consumer spending. So if you look at these estimates from Atlanta Fed now, if you look at that blue bar, that's consumer spending, you see it shrinking, shrinking, shrinking. That's most of what is bringing these estimates down.
All right, so let's talk about the time, the 1.6 print in GDP, which, as you just said, was revised lower. The concern, what caught the market, I think, very much off guard was the fact that obviously the GDP print came in light, but their inflation component in there scared the shit out of people. And I think that's why you saw pretty significant sell-off in the market and yields go higher. Now, people will explain that away. I'm not an economist, maybe correctly, but if you get whispers or hints of that again, then you're starting to talk about a potential trend where growth is slowing, but inflation hasn't been tamed. And I think that was a concern then. For me, it continues to be. We'll see what happens in the next iteration of this.
Yeah, and that's why you heard that very famous quote now from Jerome Powell at the meeting that said,
I don't see the stag
nor the inflation.
Yeah.
And I think what he was referencing is that if you break apart these GDP numbers, some of what's called private investment and this kind of private demand, those still looked strong. So as long as that's still strong and inflation is nearing target, but maybe a little above, that's where he's saying, I don't see the stag or the inflation. Also, during times of stagflation in history, the numbers were much more dramatic, meaning that the inflation was much higher, the GDP was perhaps much lower or negative. And that, if that's your definition, if that's your bailiwick for what stagflation looks like, yes, we are not in that particular situation right now. So right now, not an issue. And in fact, this would even tell you that it's possible we're going to get exactly what they wanted, meaning we're going to get a few quarters
slower
of below
growth,
trend
right.
growth. Inflation will come back down to target, and then we can coast through the end of the year with starting cuts, getting normalization in monetary policy, et cetera. It's possible. I don't think it's ever happened.
I was just gonna say it would be historic if it were to happen the way, again, given the backdrop of all the different things we talk about. And part of the component, part of what's necessary, I guess, for stagflation, obviously, is a sort of a tick up in the unemployment rate, which you obviously alluded to earlier. And that's something that he said, I think he mentioned that as well. And a lot of people have mentioned that since. Your next chart, though, suggests, I don't know if we're on the precipice of something. Again, I think we are. Some of the revisions you've seen in some of these job numbers suggest that the unemployment rate, which has been, steadfast below 4, as you mentioned, for the better part of 2.5 years, might be starting to turn. Thoughts?
Yes. Okay. 2 big thoughts on this topic. First and foremost, inflation has been the main focus of what we think about when we talk about the Fed, and it's been the main focus of Jerome Powell's comments, largely because the labor market just hasn't been really newsworthy. There's been not much to talk about. I think that's going to shift as inflation comes back down towards target, and as investors get more comfortable with the idea that maybe they will reach target, or maybe the Fed will get comfortable with a target that's slightly above 2%, we're going to shift our focus to jobs. So this chart, There's actually another way to measure jobs, and that's what this blue line in the chart is. It's the quarterly census of employment and wages. This is something that the government puts out. It's very lagged. It doesn't come out until 5 months after the quarter ends. It's why it doesn't really ever make headlines, because by then it feels like stale data. But here's the thing. Over history, once everything's been revised, the actual non-farm payrolls data tracks this very closely. Okay. So what we're already seeing in this trend is that this quarterly survey is far below what the NFP survey is telling us on a monthly basis is actually happening in the economy. So bottom line here is that if and when revisions occur, there will be revisions in, I think August is when this happens, where you sort of do this revised report where it brings it more together. What could happen is that NFP gets revised downward, and we find out that everything that we've been trading on, and this has happened before, this has happened in prior years, everything that we've been trading on and the movements that the market has made based on healthy jobs reports should not have actually happened. Or you ask that unanswerable question of, well, what would the market have done if it knew this then, if it knew that this data was overstated then? So all this chart is really showing us is that it's possible that the NFP data is overstating the strength in our labor market.
So what's fascinating about this, it's a 5-month lag. So basically a half a year lag, which this could actually be a leading, as crazy as it sounds, what is a lagging indicator could actually be, because this data is true. I mean, if you think about it, they go back, it's true data. It's basically, there's no revisions embedded in this.
Right.
And that's so you look at this and say, as much as you want to say it's revisionist or not lagging, this could be actually very leading. And it's going to be interesting to see what happens, obviously, to that blue line moving forward, right? Therein lies the lag. And if the red starts to catch up on the downside to the blue, and what that'll mean. Again,
or just gets revised down to the blue.
Or gets revised down to the blue.
Mario, if you're listening, please send me a note. I believe the differences here too are that all companies are required to respond to this quarterly survey, this quarterly census survey, whereas the NFP is a little bit more limited. And a lot of the soft data that we talk about, a lot of the surveys that we talk about, those aren't required. People do respond to them. Companies do respond to them, but they're not necessarily required. I believe that this blue line is much more comprehensive because you don't get to opt out.
I didn't know that existed. Thank you for bringing that to light. And I think it sort of reinforces my thought that the labor market, the job market, was not nearly as robust as pundits and some of these other surveys indicate that they are. Just, intuitively, if you think about it, and this is not politics at all, but it never made sense to me that, with the market at levels that we're seeing, right, with the rate of inflation, I want to be careful there, slowing down, still going up, but slowing. And the job market, obviously, people are just not happy. They're pissed off about the economy. And I'm trying to reconcile that in my head. And maybe part of it lies in, this graph that you're bringing forward here. We'll see. But I think it's a possible explanation, I guess.
Yes, I agree. If Dan were here, he would say, let's bring it back to markets.
But he's not here.
You're right.
I mean, so if Dan were here, a lot of things would be going on. But he's not here. Okay. You and I are here.
That's true.
We can bring it back to markets because, again, one thing we haven't talked about now, the 18 minutes we're into this, is the fact that the yield curve continues to be inverted. We got down to, I think, earlier this year, if I'm not mistaken, 13 basis points-ish. And then we widen out again. As we're sitting here, we're probably, about 40? You probably have it up 45 basis points or so. That's a guess. But I bet you I'm pretty damn close. So again, the fact that nobody wants to talk about this again, and I think Barron's or the Wall Street Journal just did an article on exactly this, that, people seemingly have forgot about the fact that we are in a record number of months with the yield curve being inverted to pretty significant magnitude. And I think, that you talk about bringing it back to the market, that's bringing it back to the market. Because again, I can't figure out how that's going to reconcile itself either.
You are correct. 45 basis points.
Wow.
44.629
well, that's
to be
close.
exact.
That's,
but if we
I
do
rounded up for government
rules,
work.
45. So I've been writing about this today in my Outlook, so I don't want to totally spoil it. But we are setting a record. We've already set the record for the longest yield curve inversion. That in and of itself doesn't necessarily mean anything, right? There's not a trigger that says, okay, at that number of days, it means that it's bad or it means that we're going into a recession. That doesn't necessarily mean anything. The general belief is that the longer it's inverted, the deeper it's inverted, the harder the results will be on the other side for the stock market and for the economy. What I find interesting about this is that we've had these periods of the market, yes, we've had little corrections here and there, but nothing all that serious. No. So we've had this really unabated market rise all during a period, maybe not all during the period, but during a period where the yield curve has been inverted. And I think that that's no coincidence. There is some support happening because the curve is inverted, because what we're looking at is we've got a 10-year that perhaps maybe it's lower than it should be, and that's what's keeping it inverted. And at the very least, a 2-year that's higher than it will be once the Fed starts to cut rates. So the market is looking at that as, well, maybe that's all good news, right? The 2-year comes down, the 10-year stays. I'm skeptical that the 10-year stays. I'm also skeptical that the 2-year comes down in a peaceful fashion. Mm-hmm. So this inversion still matters. This is not the only inversion. We've talked about it many times, but that near-term forward spread, you've got 3s, 10. I mean, there have been multiple inversions across the market for a long period of time, which in their simplest form suggests that rates will be lower in the near future than they are today. And then the question that I think everybody is trying to still answer is, why will they be lower?
Fair. Yeah. What will be the reason why? Like, what is going to be the trigger for that? And we've talked about it. Be careful what you wish for, which takes us to your next slide, which is the number of rate cuts over the next year and a half. And that obviously was, I think we're north of 9 at one point-ish, around 9. It obviously cascaded lower. Now we're back on the rise. I think we're close to 5 or so over the next year and a half. We'll see how that manifests itself, when they start and, how concentrated they are. But here we are. What is this telling you?
Well, so it's risen a bit. Obviously the market came in line with the Fed and decided, okay, 6 was too many this year. Then we just kept pushing it out. Now we're somewhere between 4 and 5 cuts over the next 18 months. Part of why this chart is included is because of the last slide we talked about with the labor market maybe sending mixed signals. If we do find out that non-farm payrolls are overstating the strength, summer could look very volatile for rate cut expectations, because if we find out that the labor market has actually been weaker than we thought for this period, I'm willing to bet that rate cut expectations go up quite a bit, which again, we have mentioned, don't beg for that. Sometimes it seems like the market is begging for rate cuts. Don't beg for that, and don't beg for rate cut expectations that go up very quickly, because that typically means it's in response to something bad. And I can't stress enough, this Fed meeting next week, I know it always feels like it's the most important meeting since the last one, right? But this Fed meeting next week, we're not going to get a move. They're not going to change rates. And there's a 0% probability of that priced into the market. But it happens on the same day as CPI is released. So there's a lot of big data coming that day. And as usual, Powell's commentary is going to be more important than really if they did anything on the committee. And we will get a dot plot and an updated summary of economic projections. So next Wednesday is a big day for the market.
Stay tuned. Yes, stay tuned. And you're right to bring that up. And that's obviously going to come in the wake of this jobs number on Friday. So there's a lot to digest. You said earlier that you did some of your own work and you sort of went and archived some other people's work. And that comes in the form of Jim Bianco in a tweet that he put out. But you put a graph too. And when you see it like this, the importance of these basically 3 names, this is a stark reminder of, or 4 names, the weight that's being carried by a very small percentage of stocks. And when you see it, I mean, it's startling to me, at least.
Yep. So this is showing you the market cap change of the S&P, and then it shows you basically the contribution of each stock to that change. And as you can imagine, NVIDIA has been a big contributor. I think it's about 35% or so of that rise. And people will say, well, who cares, right? What's the big deal? The big deal is that you get so concentrated in those names. There's another chart that accompanied this tweet from Jim. You get so concentrated in those names. I mean, this is staggering. Since 1960, 63, maybe? I can't read the tweet.
Or in 1960s.
60 years. That's the last time the market was this concentrated in 4 names. So again, why does it matter? Who cares? If you're invested and if you've got the ETF, you can ride the whole thing up. True, you probably are benefiting from this in some way, shape, or form. The issue is that as the market cap increases of all of these companies, so does your exposure to them. So does the concentration in your own portfolio. And if and when some of the air needs to come out of that balloon, and I'm not suggesting that the AI thing is not correct or none of that, but anytime you have a new theme and new enthusiasm, there's bound to be a little bit of a give back. There's this boom and bust cycle that it goes through. If all investors are positioned and overexposed to this concentration, then everybody feels it that much more painfully when the air comes out. So this type of chart, to me, it's like you look at this and you say, what does that tell you? Some people might say, oh, okay, so we're a little top heavy. Some people might say, thank God I own those names. I look at a chart like this and I say, I got to make sure that I own a bunch of other sectors and stuff that isn't in this at all, because I need that diversification on the other side. I'm not saying that you look at this chart and you need to like go buy gold and shove your money under the mattress, but diversify your exposure in the equity market, because this is dangerous.
Yeah, I think it's very dangerous. And again, I think with passive investing, it just sort of exacerbates this entire thing, because, you know, the money flows that are into not only the broader market, but then these specific names in the forms of the ETFs are in and stuff is such that it's regardless of news flow. You know, money flows in each day, regardless of news flow, 98% of the time. The 2%, the news flow is such that it scares the shit out of people, and you go from passive investing to active. But, you know, short of that, the money flows are there, and we're seeing it day after day, which is one of the reasons that, you know, Apple, again, regardless of news, most of the time, it's just sort of a levitation. And now we're finding it with some of these other names as well. I am startled by this, because when you see it and you realize it's the first time in 60 something years, I mean, that's interesting. And then it's just an overlay of all the other things that we talk about, which, again, I don't know. I mean, they're worrisome to me. Let's pull up our S&P chart real quick, because why not? You know, we're just talking about the equal weight. So this is the regular S&P. You see we're effectively at all-time highs today, and you see how far away we are from the 200-day moving average. And if you go longer term, this is a static chart, but a longer-term chart will show that, you know, we obviously had that brief sell-off in April, but that got us nowhere near the 200-day, got us down to the 50-day, and here we are now. But this is the one that more and more people are talking about. There's the non-static one. Let's talk about the equal weight, the RSP, and its trading performance, because it's obviously, then this basically goes back to what we were just talking about in terms of weighting of those 4 or 5 different names. This tells a much different story, Liz.
Yeah, it does. Well, what's interesting is that as the year began, and I think this has happened for the last 2 years, we had this big broadening out story, and that meant that cyclicality was back and everything was going okay. And that's true for pockets of time. That's been very true for pockets of time. But then you look at something like the equal weight giving a lot of its strength back because small caps haven't kept up, because, as the chart we just showed said, we've got this, again, top heavy concentration in the market. So the equal weight is going to lag because it naturally is underweight those big top performers. And small caps remain the only index that has not made new all-time highs. And that is something that I think we all need to pay more attention to. I think most people in media are sick of hearing about it, because it just seems like this index that doesn't go anywhere and doesn't do anything. And that may be true. And there may be certain reasons why things have changed, and why small caps naturally are sort of something that companies graduate out of. You want to be the next generation of blue chips. So the survivorship bias kind of works in the other direction. The survivorship moves into the larger cap indices, but it is indicative that we cannot get off the mat here. And that equal weight index is not going to come back to life or show a durable pattern of sustaining this broadening out until something happens here.
Before we get to Butters, it's going to be interesting to see, and I look at it through the lens of the IWM, sort of that 207 level has been resistance for a couple of years now. And if rates continue to move lower, one would think it would be supportive of the small caps. But then the flip side of that coin is, are rates moving lower because we're starting to see, I don't know, some of the economic data softening? But that flies in the face of what we saw today. So again, the cross currents that are moving these things or not moving these things, depending on how you look at it, It's fascinating. And I don't know how it resolves itself. I think with the number of small and regional banks in the small caps, I think it resolves lower because of some of the exposure that they have and the underperformance of the KRE. But that's just me.
Yeah.
Before we get out of here, because you're on a clock, if it's Thursday, it's typically Butters, as I mentioned, but it's not. It's Wednesday.
That's right.
But you are exquisitely positioned to sort of talk about this. And let's go to John Butters' work. John Butters, of course, the senior earnings analyst at FactSet, and we love FactSet here, obviously. And this is what he brought us today. The term recession has been it's been cited only 29 times for S&P 500 companies, the lowest since the first quarter of 2021. Seventh straight quarter that the number of companies citing recession has declined quarter over quarter. I guess that's a good thing because we had a similar conversation with this about inflation, right? When inflation was basically, everybody was talking about it. That was effectively marking the top. The same way I think that nobody's talking about this now, maybe is marking some sort of, I don't know, pivot point in terms of where we really are. Because when everybody talks about something, as Carter always says, you typically go the other way. Now, nobody's talking about this. Maybe it's time to look at it through a different lens. Thoughts on that?
Yeah, I mean, I would put this in the camp of, first of all, as a CEO or CFO on some of these earnings calls, you don't want to be the only one in your industry who's talking about recession concerns. If you know that other people aren't going to say it, you're the only one that comes out. You're the only one that comes out and says it. Not only does it look like you're not paying attention, maybe, or what in the world do you see that the rest of us don't see, but it could send a signal, maybe a misguided signal to investors that you are having trouble in the business, right? And you're trying to hedge it by saying, well, there's recessionary concerns and yada, yada, yada. So don't underestimate the psychological effects that happen here. But I do agree that when you get to a point where nobody's talking about it, that's when sometimes you get caught off guard. So you have to be careful in that sense. And I think right now, I mean, a lot of companies have their way of measuring recession readiness, and they have their way of measuring whether or not it's likely. There aren't that many things in the data right now that are telling us it's all that likely. So perhaps in this moment, it's not. I'd be willing to bet that companies are being more conservative than they're letting on in some of those statements.
I think what's interesting for me is, first of all, you're spot on with that. The fact that Jamie Dimon continues to be the outlier in terms of, he doesn't use, I don't think he's used recession, but he's obviously concerned about things. So as far fewer people are talking about it, he's seemingly the one person out there that continues to bang the drum. So we'll see, I sort of side with him and I sort of see the same things that he's seeing. Not the problem, but when the market doesn't verify that, people have a way of looking past it all because the market is the judge and jury of this entire thing.
Yep, that's right. And until the data shows us otherwise, we're going to believe it. The soft data, the surveys, when you ask people how they feel, not great.
Right.
But when you look at the hard data, it's just not there yet.
You know what I do feel great about?
What?
Our relationship.
Oh, me too.
We're not going to see each other until this weekend.
That's right.
And I mentioned that because I think, am I doxing you?
No, I don't even know what that means, but we already did it. We did it last week.
About it. Elizabeth's getting married on Saturday, and I'm invited with my wife, and we're thrilled to be joining you. But on behalf of all of us here, we wish you nothing but the best. We adore you. I think the audience has come to absolutely fall in love with you for a myriad of different reasons, all founded, by the way. No, it's true. You're wonderful. No, you're brilliant. You're fun. You're edgy as hell.
Oh.
I enjoy this. Hopefully
Thank you.
Do as well.
I enjoy it too. I have so much fun doing this. And thank you to the audience. You guys are awesome. Thank you for participating, for all of your questions, for everything, for watching, for letting us into your cars and your headphones and your living rooms
every day.
I mean, I don't understand it sometimes.
Nor do I. And if you see some of the comments on the Twitter, at least.
Right.
But listen, it's been a privilege getting to know you, and we're looking forward to Saturday, and I'll see you on the HTR Friday.
Yes, I'll be on the HTR.
That's Friday. The halftime report.
Working the
I hope Scott says some nice things.
Oh, well, I'll tell him you said so.
Please. But until then, we'll be back tomorrow. Tomorrow, Dan is back. I think CBW is back. So we're going to have fun tomorrow, and there's a lot of day left today. I don't know what the rest of this day holds. Market's making all-time highs. as we speak. So once again, label me confused, but I've been that way for a while, Elizabeth.
Same. You know what? The market surprises me every day. And a quote that I've used to close a lot of my written pieces, I'll use it here from my dad, the former coach. If it were easy, it wouldn't be any fun.
Damn straight. If it would be easy, everybody be effing doing it.
Everybody would do it. Yep.
By the way, what appears to be easy right now is playing baseball in the Bronx because they're kicking everybody's ass. And Hockman's giving me the thumbs up. And the NHL Stanley Cup starts on Saturday, day of your wedding.
Oh,
so the Oilers, no,
about that.
not at all, because my team is not playing.
Okay.
But the Oilers of Edmonton are playing the Panthers of Florida, as you know.
Okay.
You don't care.
Next year, I'd like to get into hockey.
I think you should.
Can you help me with that?
Well, we went to a game this year, wasn't it?
I
this year,
it. Yeah.
With your friend Amanda.
I've gone to 2 games this
who's
year.
An edgy. She's an edgy.
She's really into hockey.
She's really into it,
Yeah.
and she's a little shit.
Yeah. Well, I think she's just a little shorter than me. She's not.
No, but she's like
tiny. She's petite.
Petite.
She's petite.
But she's like strong petite.
Oh yeah.
Like I wouldn't mess with her.
Fiery.
Fiery.
Yeah. Small but mighty.
Small but mighty. We'll see you later, everybody. Thanks.